Hey everybody, happy Monday. It is Labor Day, September 2nd, just after 5 p.m. Eastern Time. U.S. equities markets closed today. Futures market closed early. We had some little bit of volume in the futures market, a little bit in Forex. Let's take a look at everything today. Just want to do a little market outlook. I had a live session earlier this morning. So I've got an interesting chart here. I've made reference to this in TradingView doing some past videos. Basically, you have the SPX and the NDX, so your S&P, your Nasdaq, your Russell. I could put the Dow up, but the Dow is pretty much the same as the SPX and the NDX. We've also inched and notched some higher highs on the Dow Jones. We've had 3 fresh all-time highs in the last couple of weeks since our August 5th bottom. And then the Russell, we're still looking to see if we can make that push. It's another like 11% or so to get to the all-time highs. But the comparison I've been looking at is when the Fed starts to cut, what is the typical performance of the stock market? And historically speaking, the last time I could find a cut cycle that yielded positive traction in the stock market would have been the cuts that started back in 1998. So right here is where the Fed funds rate was cut. You can see that shortly after that, they started to raise rates. This ended up going into that bubble that we had for the dot-com bubble, 2000, 2001. But since the cut, 2000, 2001, not so hot performance for the stock market. Nasdaq down a ton, S&P down a ton. We started to raise rates again back in 06, 07. Of course, we know what happened there in 07, 08 with cuts starting again. We peaked out. We started to crash hard. That was a great financial crisis. Last time we had rate hikes again. Here's your cycle from 2017 to 2019. Started cutting in 2019, led to a little crash, exacerbated by COVID and everything else that happened in such a short amount of time. But obviously, performance was not great. And there was all sorts of emergency measures and liquidity that was flooded back in the market. So I wanted to add to this and look at the money supply. So the Federal Reserve money supply is going up. So it's tapered off a little bit since around May of 2022, but it is still elevated. You look at Japan, money supply still elevated. You look at China, still elevated. I don't really have an example to show when money supply goes down. So I'm not sure how important it is, but I do want to watch this just in case if there's something that changes where global money supply does go down or rather plateau and taper off. Again, I wonder how that affects the overall performance of the markets. I would imagine probably not that great. We have had mostly debt-fueled rallies for the last 20 plus years. And I would imagine that right now we're probably going to have to do the same thing if we want to see continuations higher. It's probably going to be on the coattails of debt. So that brings me to what I want to address today. We're sitting here on the SPY just off these all-time highs. The month of August, what a wild month that was with just a horrible start for August 1st, 2nd, and 5th. We had that massive bottom. Look at this wick. This is crazy. So August, there it is. I mean, lows at 510. Let me see what this actually looks like exactly on the open, high, low, and close. So the candle itself, we have the high, which I believe might have actually been Friday. Well, I'll double check that on the daily in a moment. But the low was 510, the high at 564. From low to high, you're getting a rally of around 10.4%. That is a big, huge recovery by the bulls. Go to the daily time frame here, and if we weren't above it, we were super close to the monthly highs. I actually think we had to be close. This recent high would have been August 26th, and here we are, August 30th, to wrap up the month. The high 564.20, 563.91. So, yep, we sure did. We closed on a high to recover for the month about 10+%. Stellar comeback. Bulls clearly were enjoying the panic that we were fortunate to have some good data roll in. We had a bit of a reverse cup and handle pattern that proceeded to get above these major. I thought this would certainly be a bit of a roadblock between this 535 and 540 handle. Once we blasted through that, it was just pretty smooth sailing all the way back to the highs. Now, the markets aren't created equal, of course. The S&P is just off the all-time highs. We have the Nasdaq with a little bit further to go. But what I'm noticing here and heading into the typical seasonality we see in the markets for September, we do have a lot of data to get through. So I've talked about this in some live sessions. I think this is important if I do video updates like this. The big September 18th FOMC meeting, this is a big deal. Now, I'm not sure if it's going to be buy the rumor and sell the news, which means that all of the cuts potentially we're trying to get priced in through this two things. Number one, this drop in the markets forced the Fed to be way more dovish and really explicitly dovish with the FOMC that they had. Actually, it wasn't even FOMC on the 31st because the market started to tank shortly after that. It was really Jackson Hole with Powell's speech on Friday, and that would have been I want to say that would have been back in August. So Friday the 23rd would have been Powell's speech being pretty definitively dovish. And I think that the first headline that I read was, it's time for a policy change or time for a policy adjustment. And, a lot of that was already being priced in. It's just a matter of, not when they're going to cut here, but how much are they going to cut? So the market's certainly anticipating a cut in September. And then it's a matter of, is it another 25 basis points in November, or is it a 50 basis points cut between November and December? But arguably, the market's looking at about 100 basis points baked in to cuts by the end of the year. It just depends on if they're going to cut, 50 basis points 2 days after the election, or if it's going to be 25, 25, and 25, or 25, 25, and 50. We don't know that. The Fed Watch tool, if you check that out, will be giving us probabilities we can trade on. But this is the September 18th FOMC meeting. That's going to be the big one. Through the month of September, we also have 6 central bank rate decisions. Okay. So we have a lot of central banks that are likely going to be cutting. I think the only one that wouldn't be cutting would be the Bank of Japan. They'll probably hold rates the same around that quarter of 1%. But the ECB is expected to cut. The Bank of Canada is expected to cut. The Fed is going to be cutting. Bank of England possibly cutting. Swiss National Bank, I'm not sure what they're doing yet. That's towards the end of September. But if they cut, you'd have all major central banks cutting. We could see the Reserve Bank of Australia cutting. The RBNZ has already been cutting for New Zealand. So we're definitely heading that direction where a lot of central banks are looking to cut by 25 basis points at a time, possibly quarterly, possibly, every couple of months. And it's kind of narrowing that carry trade. But this is also, if it's done properly with good timing and economic data continues to point in the right direction or is stable, then we could still continue this melt up. Now, for the technical side of things, I would personally like to see the market, have a little bit of a dip here just to offer some buying opportunities and then carry this into the end of the year. But if we do crack these highs, the one thing that happens with these markets is it can stay irrational longer than traders can remain solvent. I certainly don't want to be more than, an option trader up here. If I'm going to do a bearish trade, it's going to be a bear call spread. That's about it. I was also contemplating something in the futures market where I could buy, if I went to the ES feed here, if I went to ES, and I could buy probably a 6,000 out of the money call and create probably a vertical spread there. I'd be willing to pay for it. I want to see what the out of money cost me. But if I did like a 6,000 by 6,100, or even try to move this up higher, 6,000 by 6,200, depends on how much time I can get in that trade. But we're only about 6 or 7% from those highs. So if we do get to 6,000, that'd be about a 6% move to the upside. I do think the market's very capable of doing that. And to the downside, I'd probably be looking something back in here and possibly the lows. If I wanted to be, cheaper, obviously it'd be, out of the money here and pay for something around like the 52 handle. And if I go up towards 6,000, somewhere up here. So I want to price those out this week and see, where we are sitting. If I'm long the option, obviously I'm going to lose on some time decay, but I'm willing to go out to probably Q1 of next year and see if I'm rewarded for that, having some type of time value left in those option trades. I would like to see a little bit of a pullback in September. If we're sitting here near these all-time highs, we have breached this level. We're very close to this level. I could see the market poking these highs, possibly getting to all-time highs and then turning back south for a little bit of consolidation, or possibly even a bit more accumulation where we now have this low, we have wherever this may top out, and we're looking for some type of buy zone in here to then lead us into a Q4 rally. That would be maybe wishful thinking. I think the hardest thing to do would be to stay bullish, stay bullish, stay bullish the entire time. But if that is the case and the market would rather melt up, I don't really want to stop it. So my bearish trade is going to be stopping out right in here. If we break these highs, I'll take a couple of option trades, a bear call spread with defined risk. If I'm right, I get paid for the month of September, October. If I'm wrong, I take a small loss, and the most of my portfolio will still gain with positive traction and positive drift to the upside. So my plan for September as things kick off, like I said, we do have a lot of data to dissect. If I go back into the SPY here, September 18th is a big Fed news, but before that, we do have a lot of news. So yes, it's Labor Day. The market's going to kick things off on Tuesday. This week we have employment data. So we have ADP numbers. So this is ADP non-farm. We also have unemployment claims for the U.S. We also have JOLTS, which is the job openings. And then we have non-farm payroll on Friday, which comes equipped with the unemployment percentage. So unemployment rate and the average earnings and the jobs numbers, right? So that's this week. The following week, we have CPI and we have PPI, and we start to sprinkle in central bank rate decisions leading up to the Fed on the 18th. So that next round of employment news comes this week. Next round of inflation news comes the week after, and then we get into the Fed in the middle of the month, September 18th, with a lot of central banks sprinkled into it. So I do expect volatility. Okay, it may not translate much into direction, but we could have some highs and lows and some wicks. So if we go back into, let's say, the volatility index or the VVX, so let's go VIX. We're trading at 1501. 15 is moderately elevated. High teens, or here's highs at 17, 18. Again, moderately elevated. We get above 20. I'm watching that pretty carefully. Below 15, low volatility like we had for most of the year. Are we going to have another volatility event? I don't know. I would hope the market learned a little bit more from this than it did the first time. It's not really the market learning from it. It's more participants. Like, how freaking levered is everybody to, selling volatility? How levered is everybody in the futures market? How much exposure do people have on just, hoping the market melts up higher? We'll see. But I do think there's going to be some type of, somewhat elevated volatility between 15 and 20. Maybe nothing that surprises to the upside. We saw a bear market back in 2022, but a lot of the ranges were from 20 to 35, 20 to 35. It stayed like that through most of the year. And if you coordinate that with, what the stock market did, we had a pretty solid 5-wave move to the downside, and it just stayed elevated volatility wise. And it was, down 10%, up 8, 9%, down another 10, 12%, up 8, 9, 10%, down 15%. I mean, it was pretty big. But volatility, we never had a singular outlier like we did in August of this year. So that's what's going to be interesting with how it all gets priced out. And we'll be watching volatility to see if it remains elevated. But as far as my outlook goes, I would like to see the market stall a little bit, offer a chance to give us some accumulation in here before we go higher. So if we continue to melt up, so be it. If the market gets all excited pricing this all in prior to the September 18th Fed decision, so be it. But if the market gets a little jittery on, stagnant, I'd say stagnant or even a miss in employment numbers, if we have non-farm payroll this week and it's a big disappointment, or we have a rise in unemployment rate, all these things will potentially trigger that sensitivity that the market had back on the 1st, 2nd, 5th of August. And we'll see if that is going to bring the market down a little bit. So I really think it's price action that tells the tale. If we're going down, the SPY has to break the floor around 555. If we're going down, the Qs will be breaking fresh lows around 468. If we're going down here on the Dow, I'd like to see the Dow take out around 409. I'd like to see the Russell take out around 216. If those levels are not breached to the downside, then more upside, more melting up. We'll see what happens. And then just watching the VIX to see if it's staying in the teens, 15, 16, 17, moderately elevated. If it ends up drifting lower, then it certainly favors buying options and melting up higher versus a vol event once again. And then the dollar index has pivoted pretty hard off that 101, or it was actually 100.50. I'm looking to see if the dollar can pivot again, but dollar weakness seems to be in pretty good shape. Looking for the next, maybe I'd say 2 to 3 months. This might even be a bigger level through the rest of the year. We've got about a halfway point around 104. I don't even know if we're going to pull back that far. The dollar could do something like this, where it just pulls back briefly, consolidates, and then starts to flush back down. I also think this is a good opportunity if the market's going to rally. We want to see a broad market rally on the stock market, broad market rally in oil or gold or silver or even Bitcoin. I do think the indexes go higher if the dollar gets weaker. I do think that gold and silver and Bitcoin go higher if the dollar gets weaker. Bitcoin is certainly tied, not crazy correlated, but tied to the broader markets. I mean, when you have risk on trading, Bitcoin benefits from that. And we're seeing Bitcoin making lower highs and lower lows. We're trading around 59K. But this could also be another, big breakout type move if we just consolidate. And we could use the whole channel, obviously. We can come up towards, 67, 68,000, reject, come back down to the lows again, come back up. We can channel around it here. But to me, after this type of swing, all this is accumulation. And I'm looking to see if and when we can break fresh highs. That's where the bull market, I think, resumes on Bitcoin. So I do have some nice exposure on Bitcoin across some of those ETFs, as well as just owning Bitcoin and just doing some spot trading, some Bitcoin futures as well. And I am, you know, for risk capital wise, I'm certainly looking for some upside potential. I think the trade lines up pretty nicely. I've measured some symmetry up on Bitcoin all the way up towards 103. And if we pull back to roughly this 45,000 mark, then I'd be pretty bullish into there. And, obviously trying to bide my time and make sure that if I'm going to get aggressive, that we have some open space to trade. So I think the dollar plays a big part in all of this to see if the dollar's weaker, that everything looks pretty good one way or the other. So I think for the sake of time and Labor Day, and we'll be back at it this week, that'll do it for me today. But thanks for watching. Thanks for checking it out. And I'll see you in the live markets. Take care.